Welcome back, everybody, to Volatility Trading Strategies. So who among us hasn't at some point felt the stock market was a little bit overvalued and was considering actually shorting it? I know I have. The problem with this thinking is that's a lot easier said than done. This is a chart of the S&P 500 since 1928, and it seems pretty clear the long-term trend is upwards, right? Now, I know when people say they want to short stocks, they don't mean forever, of course, they just mean they want to try to catch a few of those down periods. But since none of us have a functional crystal ball, how are we going to know when to ride the trend upwards versus when the market is weak enough that it might be time to short? That's what we're going to talk about today. So a very common volatility metric that some traders out there use to represent those periods of market weakness is when the VIX futures is in what we call backwardation. So first of all, I'll explain what backwardation is, and then after that, I'm going to show you a test of what would happen if a trader shorted the S&P 500 only during those times of VIX futures backwardation. The results might actually surprise you, and they do illustrate just how difficult it is to make money shorting the stock market. So as always, the best way to support my work is simply subscribe to the channel and give the video a like. Just takes a second, do that now, and then let's talk about this very important subject. So really quickly, let's just go over what backwardation is, and then we'll get into the test, which will surprise some of you about how unprofitable that strategy really would be. So this is the current VIX futures term structure for June 16th, 2021. Now, whatever type of trading you focus on, stocks, bonds, commodities, options, even crypto, I believe that every single trader out there needs to have at least a basic understanding of this VIX futures term structure and what it says about market sentiment. Now, if you want a dedicated video that will get you up to speed, I'll leave a link here above. It's only a 20-minute video, but it really will explain everything you need to know, and I think it's a must-watch for all traders out there. Alright, so the up-to-date VIX futures data can be found anytime at VIXCentral.com. All of these points on the chart represent a monthly VIX futures contract. So this front contract expires in July, followed by August, September, all the way out in time. For today's video, all you really need to know is, when this second month future is trading at a price above the front month future, this is called contango. It typically represents a period of general market stability. And if you're bullish on the market, ideally you'd want to see all the further out futures priced higher than the previous month. That's what we see now. Markets are stable, we're near all-time highs, and we see a nice upward sloping term structure. But this here is an example of VIX futures in what's called backwardation. This was on January 27th, 2021, a little earlier this year. Now that date was significant because it was actually the third largest VIX spike in the last 30 years. And that elevated risk and uncertainty shows up in the VIX futures term structure. We can see that the second month was actually trading below the front month. And the third, fourth, fifth, they were all lower than the previous month, with a downward sloping curve that we call backwardation. Again, for the purposes of this video, all you really need to know is that contango, or upward sloping curves, is normal in times of general market stability, and backwardation, or downward sloping curves, are seen when the markets are showing weakness and elevated risk. So here's the front 2 months of that VIX futures term structure plotted over time since 2004. We can see that on 83.6% of trading days it was positive, or in contango. Remember, that's the upward sloping VIX futures curve representing normal markets. 83.6% of the time, that's what we see with markets relatively stable. Only 16.4% of the time we are actually in backwardation, with clear signs of elevated risk. So what a lot of traders out there believe, and trust me, I've heard this 1,000 times, is that all you have to do is wait for those times of backwardation when the market is screaming warning signs, and then you short the S&P 500 only during those times, which again is about 16% of the time. Sounds like a good idea, right? It's a quantifiable metric that definitely does show when the markets are the most dangerous, so shorting the stock market during these periods should work out pretty well, right? But actually, no, not so much. This is what it actually looks like. Shorting the S&P 500 during periods of backwardation would have lost you half your money in the last 17 years since the VIX futures launched in March 2004. That translates to an annualized return of minus 4.28%. And that may be a surprising result for some of you, since there are a lot of people out there who talk about this contango backwardation threshold as a great trading metric. A flip point, if you will, to go from long to short and vice versa. But we can clearly see that it really doesn't work out very well at all. Now, backtests are easy to do, and we can always see that data. It is useful, but that's only telling half the story. The most important part is the why. Why does shorting during times of backwardation not actually work? Well, it's not that it never works. We can clearly see some periods where it accelerated growth quite quickly and seemed pretty successful. The financial crisis in 2008 stands out, where for several months those trades would have done very well. The European debt crisis in 2011 had some short-term success. The Q4 2018 crash that saw markets down for 3 months straight would have had some nice profit. And then, of course, during the global pandemic in 2020, shorting the market during those rough times would have worked very well. But if you're noticing the pattern here, even after some success during the worst market crashes, most of the gains are given back pretty quickly afterwards, and then it continues to bleed downwards. There's actually two things that are contributing to the poor success long-term of this signal, and I think it's important that we break them up and talk about them separately. So the first problem is, outside of the biggest and most memorable market crashes, the results everywhere else do just slowly bleed down over time. The reason this is happening is when the VIX futures term structure goes into backwardation and it does signal weakness and overall risk in the market, unless it's a full-on market crash, for the most part, the market recovers quite quickly. That means you're entering your short S&P 500 positions right when the market is about to go back up. So you just keep suffering those small paper cuts along the way, which individually might not be a big deal. But taken together, the accumulation of the bleeding over time is what kills the trade and leads to such bad results long term. So that's that slow bleed aspect. And because of the repetitive whipsaw over and over, that's one of the things that's contributing to the very poor results long term. The other reason, as you can see in this chart, even when the markets do see one of those more memorable crashes, there is significant give back afterwards, which sometimes takes it right back to where it started before the crash. To see why this is happening, we can zoom in on some of those major crash periods. Here's the financial crisis in 2008, and remember, shorting the market during VIX futures backwardation did make a nice profit for quite a while when stocks were crashing. Unfortunately, during times of crisis, volatility metrics like the VIX futures can be quite sticky in those higher ranges for quite a while, even after the worst of the crisis is over. That's what causes the give back, where profits that were made may start to be lost on the other side. VIX futures can remain in backwardation for several weeks or even a month or two after the crisis is over. Stocks are going up at that point, but shorting the S&P 500 during backwardation would mean that you're still short the market on the other side. To make matters worse, we do know that some of the very best periods of stock market performance are immediately following some of the biggest crashes. Those V-bottom bounces on the other side can be really violent. And if you're still short the market because the VIX futures are sticky and still in backwardation, you could give back some or all of the gains that you made. That's what we're seeing with these spikes that end up drifting back down afterwards. I call this the dreaded give back. 2011 was a great example of this. VIX futures backwardation was a great signal to get short the market when the reality of the European debt crisis started to become more clear. The first backwardation signal flagged on August 1st, and some very nice profit would have been made after that. But while the worst of the crisis was over on October 3rd, the VIX futures didn't get out of backwardation until November 16th. So early on in this section, the trader feels like a genius, and then they give it all back on the tail end. That's why I said there's two distinct problems fighting against this type of market signal. The first is that slow bleed, due to repetitive whipsaw every time the VIX futures only temporarily dip into backwardation. That'll mean the trader is getting short the S&P right at the time the market is about to recover. And again, these might seem like paper cuts in the short term, but they really do add up to significant losses of capital long term. And the second reason is that dreaded give back. This is when the market does actually see one of those all-out market crashes, and some significant profit can be made early on during that process. But eventually the market will bottom and things will start to recover. However, volatility metrics don't recover as quickly. They can be quite sticky and remain elevated well after the recovery in the market has started. This leads to a lot of that initial profit, and in some cases all of the profit, to be given back on the tail end. Again, this is something that I really do see quite often. People thinking that shorting the market is easy. All you have to do is wait for those VIX futures to dip into backwardation, and then that's the time to get short. Sounds like a good idea in theory, and it does sound great on Twitter, but in real live trading, with the combination of the slow bleed and the dreaded give back, that strategy has been a failure for 17 years and counting, and I don't imagine it'll start working anytime soon. If only trading were that easy, right? So tune in to the next video for sure, because we're going to take the same signal, that VIX futures backwardation, and then insert some different asset classes and see if we can find a few things that might work a little bit better. So as always, if you want some help with your portfolio, you can go to the website, claim your free trial anytime. You're always welcome to join us here. Check out our live trades, our private live streams, and see if the VTS community is right for you. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.